Are you really intrigued by the idea of investing in short-term rentals, but maybe you're feeling just a little scared because of everything that's going on in the world today?
There's war, inflation, supply chain shortages, interest rate increases, and a looming recession.
And while all of those things may make you want to just like bury your head in the sand and wait for the right time to buy your first short-term rental, in this video, we're going to break down why we believe short-term rentals are still a really good investment for 2022.
We are the Real Estate Robinsons.
Hey everyone, if this is your first time here, I'm Tony.
I'm Sarah.
And we're real estate investors who quit our day jobs by investing in short-term rentals, and we're here to show you how you can do the same.
We've had so many people reach out to us over the past couple of months, worried about what's going on in the world today. There's a terrible war that's going on in Ukraine. There are lingering supply chain issues causing shortages all over the place. Gas prices are at record high.
Yeah, the economy seems poised to even fall into a recession, right? And interest rates have seen their steepest increase since the 1980s. And to make matters worse, every time you turn on the news or read an article or even just like scrolling through social media, it feels like there's more bad news. So with all of this happening, it's no wonder so many people are thinking about staying on the sidelines until things get back to some sense of normalcy.
And you might be thinking to yourself, is now still really a good time to buy short-term rental, or should I wait?
Now, we don't have a crystal ball, and we're not economists, but we do, have some homework that we did, and we want to share what we've learned with all of you. So take what we're about to say for what it is, which is just our opinion. But our hope is that by the end of this video, you'll feel more confident about how to move forward with your own short-term rental business.
Now, just a heads up, we're going to be talking through a lot of numbers in today's video. So we tried to add plenty of graphics to help you follow along.
But the numbers are super important, so make sure you're doing your best to follow along. Now, first, let's talk about some of the big fears that you might be facing as you decide whether or not to buy your first short-term rental today.
We'll talk through each of these fears, but then we'll also share our thoughts on why those fears may be unjustified and how you can overcome them.
Now, the first big fear on the rise is interest rates. We've seen interest rates steadily rise since August of 2021, when the average rate was 2.84%. And as of this recording, rates finished last month at 5.23%. And that's honestly a really big jump.
That's pretty crazy.
It is pretty crazy, right?
Crazy.
So if you tried to buy a house at $500,000 with a 2.84% interest rate, your monthly mortgage payment would be $2,065 per month. But at 5.23%, your payment will jump all the way up to $2,755 per month, which means you're paying about $690 more every single month. That's a huge difference, for the everyday American family.
And as an investor, that increase makes it harder for you in two different ways. First, if you're using a traditional mortgage where your lender is looking at your debt to income ratio, it's going to be harder to qualify for a new mortgage because it means you need to have an extra $700 per month in extra income to cover the difference.
Second, that extra $690 is going to eat into your profits. So you're literally spending almost $700 more for the same exact property. Now, unless you can decrease expenses or increase your income, your profitability could take a hit as well. So that's the challenge. Money is becoming more expensive. But here's how you can overcome this fear.
You need to focus on finding better deals. You need to buy properties that have more upside and can produce bigger profits.
Now, I know that's easier said than done, but we'll give you some actual strategies that we've used that you can also use to accomplish this. Now, first, start looking for properties that are old, that are ugly, and that are beat up. This was a shift that we made in our business last year. When we first started buying our short-term rentals, pretty much every single property was turnkey.
Yeah, they were cute and new.
Which means we didn't have to do pretty much any rehab to get the property up and running. But as the real estate market started to heat up, finding those turnkey properties at a good price became harder and harder. So we had to change our approach, and we started buying these fixer-upper properties all throughout the markets we invest in. And it turned out to be a great decision for us because we were able to force a lot of equity by completing these rehabs. So we're buying at a lower price, but still hitting the same revenue numbers as the turnkey properties because of the rehab we put into the property.
So it was a new strategy for us, but it worked out
Yeah, I'd actually done like burrs and rehabs on like in our long-term rental business.
I forgot you did that.
Yeah, Sarah wasn't involved with that, so that was her first time being involved with
it's pretty scary if you're doing it for the first time, but after you do one, it's like a game changer.
Yeah, for sure.
I think this is a game changer.
Now, the second thing you can do is look for bigger properties. And this is another shift that we made as well. So for example, right now we have a 23 unit cabin resort under contract here in SoCal. Yeah, in the city of Big Bear Lake, California. Now the total purchase price for this property was about $7 million, just under $7 million, which means we were paying like, I don't know, like 300 grand per cabin. Right now, there's no way we could go into Big Bear today and buy 23 separate cabins at $300,000 a piece and generate the revenue we're going to generate with this resort. So going bigger actually gives you a better price per unit. Now, obviously not, everyone watching this, on all of our subscribers can go out and buy a hotel for $6-7 million, but the underlying message of trying to buy bigger still makes sense. So maybe instead of looking for a single family house, you look for maybe a small multifamily that has 3 units. And if you turn each of those 3 units into a short-term rental, then the revenue per unit goes way up. And as your revenue per unit goes up, so does your profit per unit. So you're able to offset the increased interest rates by increasing your revenue.
I got a little lost there, but I think I understand the gist of what you're saying.
Buy bigger. Sometimes it's better.
Like revenue, bigger, money, profit.
The last thing you can do is try and get creative with your financing. Now, a popular strategy in the world of real estate investing is called seller financing. This is where instead of going to a bank and asking them for a loan, the seller of the property acts as your bank. Now, we just got some killer seller financing terms in one of our recent deals, and it was an absolute game changer.
For the Big Bear deal, right?
Mm-hmm.
So excited for that deal.
So it doesn't hurt to ask the seller if they'd be willing to do seller financing. The worst they can say is no. Now, the last thing we'll point out about interest rates is that if you can get a deal to cash flow with a higher interest rate, the higher interest rates we're seeing today in 2022, just remember you can always refinance later. And if the deal works today with higher interest rates, think about how great it'll be once you refinance at a lower rate. And actually, one more thing to add. I know most people around our age started buying homes when interest rates were relatively low, like our primary residence is like 3%. But you have to remember, even at 5%, those are still historically low interest rates, like seriously. Before 2010, interest had never really dipped below 5%. And in the 1980s, interest rates had gone all the way up to 18%, almost 19%, right? Like, can you imagine that? Trying to buy a house with an 18% interest rate, it's crazy. Even though we've been spoiled over the last couple of years, let's just kind of keep things in perspective and recognize that the rates we still have today are historically pretty good.
What a optimistic way to look at life, Tony J.
I try to be optimistic.
That's like the glass is half
full. Yeah.
That's why I married you.
I'm a glass half full kind of guy. Actually, I'm a make the glass full kind of guy.
Okay, Tony J. Okay, Tony.
So that was the first challenge. And this is honestly the one that impacts the entire housing industry, not just short-term rentals. But let's move on to a trend that's specific to short-term rentals.
Let's talk about the next big fear about investing in short-term rentals today. And that's the idea that the only reason short-term rentals are doing so well right now is because there was a ton of pent-up demand from COVID. And now all the people who wanted to travel after COVID have done it, and that we're all in for a rude awakening because that is all over now.
So let's look at some data to help us understand this a little bit, okay? Now, AirDNA put out a report comparing 2022 to 2021 and 2019. And now they obviously excluded 2020 because of COVID and no one was traveling. And here's what AirDNA had to say. Now, first, let's talk about the bad news, okay? The first bad news is that nights booked were down 3.6% year over year. Occupancy was down 1.7% year over year, but it was still up 11% versus 2019. Now, next, let's look at the good news. Demand is up 25.3% year over year and 25% versus 2019. Our average daily rates are up 11.2% year over year and 33% versus 2019. Revenue is up almost 40% year over year. Yeah, and 67% versus 2019. And available listings are up 19.5% year over year and up 8.5% versus 2019. What does this mean? It means we're still seeing increases in travel year over year. Now, it is hard to know if this is still some kind of,
COVID
change, COVID demand, or if it represents a shift in how people are traveling, right? On one hand, there's still so many companies who have shifted permanently to remote work, which means employees aren't tied to one place anymore, so they have the freedom to work from wherever they want. And instead of only having, to wait for those 2 weeks when you got your vacation, they can pretty much vacation anytime and just make sure they're working during the day.
That's true. And people do ask us often when they're inquiring about our properties if there's, a designated workspace. So we know that to be facts.
It's facts, right? Or it could possibly still be some pent up demand from COVID. In reality, it's probably a mix of both of those things.
Sure.
But again, here's how you can overcome that fear. Just underwrite your properties using a mix of pre-COVID numbers and post-COVID numbers. So basically, if you want to analyze a property, worst case scenario, just go to 2019. And if the deal works on 2019 numbers, then you should feel more confident that even if demand drops to pre-COVID levels, you're still going to be profitable with that property.
Look at you. Optimistic Tony J yet again. Yeah, it is. It's like half glass full.
No, that's not optimism, almost I don't know. It's like
factism.
Yeah, this is like facts, right? Just use the data.
Yeah, I get it. I was just making a joke. All right, and the next big fear is a potential recession. You hear this word being thrown around by everyone right now. And for many people, just the word recession is scary. Especially those of us who were impacted by the 2008 recession.
That was a ghost when she says,
and literally the word recession is just so scary to me too. We were in high school when. Yeah,
we were seniors in high school. It's like we graduated from high school in 2009, so smack dab.
So I didn't really know much about it. I feel so stupid that I didn't really know what was going on.
I knew a lot about it because my dad was in real estate and his business collapsed.
Well, dude, my dad owned a restaurant. Now I know why his business didn't do well. Yeah, stupid teenage life, But now that I am an adult investing in real estate, I hear the word recession, and it gives me the heebie-jeebies.
But let's actually define what a recession means. A recession means that the GDP, the gross domestic product, for the country shrinks instead of expanding for 2 consecutive quarters or 6 months in total. Now, it doesn't necessarily mean that the economy is in this huge economic turmoil. It doesn't mean that unemployment is at record highs. It doesn't mean that people are losing their homes at a faster rate. It just means that spending in the economy has cooled off a bit.
Oh, that's it?
That's it.
Oh, that was a lot of fancy words, but thanks for breaking it down.
Now, in the first 3 months of 2022, the economy did get smaller, and all signs kind of point to the same thing happening as the next quarter ends as well. But a recession itself doesn't mean you should stop buying short-term rentals. So again, I'm a data guy. I like to make my decisions based on numbers. So I dug up some data from the Federal Reserve Economic Database about recessions that have happened in America. Now, going back to the 60s, there have been 7 major recessions. So let's quickly run through each of them. 1969 lasted 11 months. 1973 lasted 1 year and 4 months. 1980 lasted 6 months. 1981 lasted 1 year and 4 months. 1990 lasted 8 months. 2001 lasted 8 months. 2008 lasted 1 year and 6 months. That's an average of just under 12 months for each recession. So the first thing to understand about recessions is that they're typically over pretty quickly. They usually don't drag on for multiple years. Now, the second thing about recessions that we need to understand is that even during a recession, people still go on vacation. All right, so we pulled some more data, this time from the Bureau of Labor and Statistics, and that shows how much Americans were spending on vacations before the 2008 crash and afterwards. And what you see is that there's this kind of pretty steady increase in average spending per year, where it was $1,293 in 2005, $1,408 in 2006, $1,462 in 2007, $1,411 in 2008, $1,273 in 2009. And then it bumped back up to $1,300 in 2010 and started to rise again from there. So we saw a decrease in 2008 of 3% year over year. And then there was a decrease in 2009 of 9% year over year. So even during a recession, one of the biggest recessions we've seen in our lifetime, vacation spending didn't go to zero. It didn't even decrease by double digits in a single year. It was a 3% drop one year, followed by a 9% drop the next year.
That's not bad.
It's not that bad.
That's not bad. Thank you, baby.
You're welcome.
You're making me feel better.
I'm glad.
And he's not lying when he says he's a numbers guy, data-driven guy. This guy has been studying recession for the last, I would say, 3 months?
Yeah.
He's literally up till 3 a.m. I wake up, I'm like, what are you doing? And he's like, I'm reading about recessions.
And inflation.
And inflation. So if you guys should listen to any guys, this guy right here, he's doing his research for you.
So here's how you can overcome this fear.
What you have to ask yourself is, if you buy a short-term rental today, could it absorb a 12 to 13% decrease in consumer spending over a 2-year period? That's the beauty of buying a short-term rental. Most short-term rentals would be able to weather that kind of storm. We could see revenue drop by 30% or more on our short-term rentals, and we'd still be cash flow positive.
So just make sure that as you're shopping for your short-term rental, that you're stress testing your deal a little bit more than you normally would, right? Make sure there's enough cushion in there in case the market does take a turn. Now, I'll caveat, everything else I've said by saying that just because in 2008 we saw these kinds of decreases in consumer spending on vacations, it doesn't necessarily mean that 2022 will be the same, right? It could be more or it could be less. It's hard to tell.
I wish we had a crystal ball, like you said, Let's rub it together.
This is your crystal ball.
Yeah. This is the crystal ball. Crystal ball. And the other thing to realize is that even if you have a down year on a property, if your plan is to hold that property for 5 years or 10 years, you'll still come out way on top by the time you go to sell it.
Now, before we move on to the next big fear, we'd really appreciate if you could give this video a thumbs up, subscribe to our channel, and hit the bell for notifications.
Every new subscriber really does mean a lot to us, and we have a really big goal of getting to 50,000 subscribers by the end of the year. So if you're enjoying the content, please hit subscribe and turn on the notifications.
Also, be sure to connect with us on Instagram. I'm at Tony J. Robinson. My wife is at Sarah Rad, and we're at The Real Estate Robinsons on TikTok. We've also got a totally free download for all of our subscribers. If you head over to alphageekcapital.com/calculator, we've put together a free tool that helps you analyze the property you're considering purchasing as a short-term rental.
We've also got an event coming up, and I'm so excited to tell you guys. It's a 3-day event focused all on teaching you how to buy, manage, and scale your short-term rental portfolio. We'll walk you through all the steps you'll need to follow to get started, and we have so many good speakers lined up to bring you even more valuable information. The event is in beautiful Newport Beach, California from September 11th through the 13th. If you want to learn more about the event, head over to strsummit.com. We've got early bird tickets on sale now, but prices are gonna go up soon, so lock in your seats before it's too late.
Last thing, if you're not yet an Airbnb host, sign up using our link in the description. You'll get a cash bonus for signing up, and we'll get a small cash bonus as well for referring you. Time for the next big fear.
Now, some of you watching may be saying, Tony, Sarah, I really want to buy a short-term rental, but my Uncle Joe and my Aunt May are telling me to wait until the housing market crashes so I can pick up some better deals. You know how many people, how many Uncle Joes and Auntie Mays we've had in our lives tell us that?
Yeah.
My point is, what is my point? Go to the next.
Don't listen to it. Listen to us. Listen to the YouTubers.
YouTube, yeah, listen to the YouTube. Don't listen to Uncle Joe and Auntie May.
So our personal opinion is that as long as you're conservative in your analyzing, you should continue to move forward with buying properties, right? There's lots of people who are wishing and hoping for this crash to finally hit us, but we personally don't think that will happen. The price increases will probably slow down a little bit, right? We won't see this crazy run up on prices, but there's nothing in the data to suggest that an actual median home price will decrease. Now, again, we pulled some more data from the Federal Reserve Economic Database, and if you look at the average home price from 1963 to the end of 2001, there were 4 periods where home prices decreased. In 1969, the average price was $25,600. And in 1970, there was a recession and it drops to $23,475. But in 1971, it increased back to $25,225. The next period was in the 90s. In 1990, the average price was $122,300. And there was another brief recession in 1991 and prices dropped to $119,975. But again, prices increased to $121,375 in 1992. And the third period was the 2008 crash, where prices peaked at $244,950 in 2008 and bottomed out at $215,650 in 2009.
Ouch, that's a big dip.
That is a big dip.
Yeah.
But again, they bounced back up, right? And in 2018, prices were $325,275, and they dropped to $322,50 in 2019, but there was no recession in 2019. So you might be saying to yourself, Tony, Sarah, see, a recession is coming, so that means prices are going to decrease, it's going to happen. Here's how you can overcome this fear. So instead of basing your decisions off of what your friends and family are saying, try making your decisions based on the data.
Data king over here.
Right, based on the cold, hard facts. Now there's actually data that shows even during a recession, prices can actually still increase. There were recessions in 1974, 1980, 1982, and 2001. And in each of those recessions, you still saw the average home price increase, right? So again, let me say this so it's super clear. There were 4 recessions where home prices increased. So our point is, just because a recession is coming, that doesn't necessarily mean that housing prices are going to decrease. And even if they do decrease, not counting 2008, the decrease only lasted 1 year before prices shot back up again. Now, the other thing to look at is supply. We're still seeing really low levels of housing supply across the entire country. Now, Freddie Mac estimated that we're short 3.8 million homes, 3.8 million with an M. So even though prices have increased, there's still this huge gap, this massive gap between supply and demand. And that gap will continue to apply some upward pressure on home prices. Now, part of that's our fault, our generation, right? There's 70+ million millennials who are all at this stage in their lives are looking to purchase their first home.
Why is that our fault?
Just because there's so many of us.
Okay, or like the boomers?
Yeah.
The baby boomers?
Yeah.
Oh, I didn't know that.
But the boomers are still in their houses and the millennials want them, but the boomers haven't moved out yet, right? So there's like all these people looking for houses at the same
I didn't know
time.
the millennials, like there was that many babies at that time.
70 million.
That's more than regular.
It's just a big number of people looking for homes.
Okay.
But the point is, even if the increase in interest rates and recession reduces demand, there's nothing to show that it's going to reduce demand by 3.8 million. So again, the price increases will probably slow down a little bit, but there's nothing in the data to suggest that an actual median home price for any sustained period of time will happen. Point is, wrapping all that up, if you're waiting for the market to crash before you buy your first short-term rental, you might be waiting for a while.
That was a lot to digest. I'm like, all these words are floating around in my head. Data, decrease, increase. We started investing our journey in 2020 with this recession and COVID. Literally, our Auntie Mays and Uncle Jims, or whatever you call them, so many people are coming at us, so concerned for us, saying, we're so young and naive and we don't know what we're doing. Fast forward a year and a half later, those same people are coming up to us, asking for advice, asking how they can partner with us. And we've grown our portfolio to over $1 million worth of real estate. Do we not have $1 million worth of real estate?
We have way more than $1 million. I think what she's trying to talk about is our net worth.
Oh my gosh.
Yeah, our net worth has eclipsed $1 million in like less than 2 years by investing in short-term rentals.
Okay, yep, that's what I meant. Anyways, I was just trying to say, don't be scared.
All right, so now that we've talked you through the fears that you might be facing and how you can overcome them, let's talk through a few other things you should maybe consider before you decide whether or not now is a good time to buy a short-term rental for you specifically.
So the first thing you have to think about is how much capital you have available. Do you have money set aside for a down payment and to cover your closing costs and all of your setup costs? Buying and setting up a short-term rental requires money. And kind of a lot of money sometimes.
Depending on the property.
Yeah. Now, one caveat is that it doesn't necessarily need to be your money, but you just need access to the money. That's something I learned in our real estate journey. It could be a friend or a family member who has some extra cash, doesn't want to put in the stock market, but they don't have the time, desire, or ability to find a good short-term rental themselves. That's where you can step in and make it a mutually beneficial relationship.
Now, we'll also say that having a healthy amount of cash reserves will help you sleep better at night, right? I know it does for us. We can cover our mortgages for a while with the money we have set aside. Right? But again, that's what we like to do, and everyone should have reserves in their business, okay?
Yeah, that's too stressful to live life,
So that's the first thing to understand is how much capital do you have available? Now, once you figure out how much capital you have, the next thing to consider is your financing options. Now, unless you plan to pay cash, you're going to need some kind of loan to purchase your property that you plan to use as a short-term rental. So talk to lenders, talk to credit unions, talk to banks, talk to mortgage brokers, and try to find the best loan option for your specific situation. Second home loans, investor loans, and DSCR loans are all good potential options.
The last thing to really ask yourself is this property a good deal? Is there a healthy amount of profit left over at the end of each month? Are you able to hit the cash on cash returns that you want? This is the question that we continue to ask ourselves every time we get a new property under contract. Is it a good deal?
If we can buy it today and confidently cash flow, then we're going forward with it, right? We're gonna buy the property, we're gonna keep adding to our portfolio. So if you have the capital and you have the financing and you're cash flowing, why wouldn't you move forward with the deal? Now, before we wrap up, we also just have to say that what we share today is just our opinion, right? We try to back up everything that we were saying with strong factual data, but at the end of the day, you have to make the right decision for yourself.
And what you're comfortable with.
And what you're comfortable with, right? Some people have higher risk tolerances and other people have lower risk tolerances. Yeah. So you'll have to decide for yourself where you land. But our hope with this video was that we were able to open your eyes just a bit and not get you too bogged down by all of the negativity that's floating around right now. So that's our opinion on where the market's at today. Hopefully hearing our point of view helps you make a better, more informed decision for yourself.
And hopefully all of Tony's, mega data research makes you more comfortable.
Hopefully, my mega data research.
Well, that's it for today, guys. Thank you so much for watching. I'm Sarah.
I'm Tony.
And we are the Real Estate Robinsons.